You see a guy with 6 monitors, 17 different analysis tools, and a PhD in finance. He's down 30% this year. Then you see another guy who bought 3 stocks because they seemed cool, and he's up 200%. You think, this makes no sense. Here's the uncomfortable truth that Wall Street doesn't want you to know. The dumbest investors consistently outperform the smartest ones. Let me show you exactly why being dumb with your investments might be the smartest thing you can do. Naive optimism versus market research. Smart investors spend months researching every investment. They read annual reports, analyze competitor data, study market trends, and calculate intrinsic values. They want to know everything before they invest a single dollar. Meet Dave. Dave sees a Tesla on the street and thinks, electric cars are the future. Dave buys Tesla stock without reading a single report. Dave doesn't know Tesla's debt-to-equity ratio or their production numbers. Dave just thinks electric cars are cool. While smart investors spent 2 years analyzing whether Tesla was overvalued, Dave made 1,000% return. The smart investors missed the entire run because they were too busy researching to actually invest. This is called analysis paralysis. The more information you have, the harder it becomes to make decisions. Smart investors get trapped in research loops, while dumb investors just buy what makes sense to them. Naive optimism beats sophisticated pessimism, because optimists take action, while pessimists find reasons not to invest. Simple ideas versus complex solutions. Smart investors create complex portfolios, 47 different stocks across 12 sectors with international exposure, currency hedging, and sector rotation strategies. They rebalance monthly and optimize for tax efficiency. Meet Sarah. Sarah buys 3 stocks: Apple, Amazon, and Google. Sarah's reasoning? Everyone I know uses their stuff every day. Sarah's portfolio is embarrassingly simple. No diversification strategy, no sector analysis, just 3 companies she understands. Over 10 years, Sarah's simple portfolio outperformed the complex smart portfolio by 4% annually. Sarah's dumb strategy generated an extra $200,000 compared to the sophisticated approach. This happens because of complexity bias. We assume complex solutions are better than simple ones. But in investing, complexity often reduces returns while increasing costs and confusion. The dumbest investors stick to what they understand, which often happens to be the best companies in the world. Beginner's luck versus experience. Experienced investors know every market cycle, every pattern, every indicator. They've seen crashes, bubbles, corrections, and recoveries. They have 20 years of knowledge about what works and what doesn't. Meet Mike. Mike bought his first stock ever in March 2020 during the crash. Mike had no experience, no knowledge of market cycles, no understanding of valuations. Mike just bought growth stocks because they were on sale. Mike's beginner portfolio crushed experienced investor returns because Mike bought at the perfect time without knowing it was the perfect time. Experienced investors were too scared to buy because they knew how bad crashes could get. Experience becomes a liability when it creates fear. Experienced investors know all the ways investments can go wrong, so they hesitate. Beginners don't know enough to be scared, so they buy when prices are low. This is why beginner's luck isn't luck. It's the absence of fear-inducing knowledge. Beginners make optimal decisions because they don't know enough to make suboptimal ones. Fast action versus perfect planning. Smart investors create detailed investment plans. They wait for perfect entry points, analyze optimal timing, and plan for every scenario. They want everything perfect before they invest. Meet Jennifer. Jennifer hears about Bitcoin at a party and buys some the next day. Jennifer doesn't understand blockchain technology, mining, or cryptocurrency fundamentals. Jennifer just thinks digital money sounds interesting. Jennifer bought Bitcoin at $3,000, while smart investors waited for better understanding. By the time smart investors finished their research, Bitcoin hit $60,000. Jennifer's fast action beat perfect planning. Smart investors miss entire bull runs while planning. Dumb investors catch trends early because they act on incomplete information. In fast-moving markets, speed beats precision. Perfect planning has an opportunity cost. While you're planning, prices are moving. The market doesn't wait for your analysis to be complete. Sometimes good enough and fast beats perfect and slow. Trial and error versus analysis. Smart investors use complex models. They back-test strategies, analyze historical performance, and run Monte Carlo simulations. They want mathematical proof before risking money. Meet Carlos. Carlos tries different investments and learns from results. Carlos bought some tech stocks, lost money, learned that growth stocks are volatile. Carlos bought some dividend stocks, made steady returns, learned that boring works. Carlos's trial and error approach taught him market lessons that no amount of analysis could provide. Carlos learned through experience, not theory. Carlos's education cost money, but provided real knowledge. While smart investors analyzed, Carlos gained real market experience. Carlos made small bets, learned from outcomes, and adjusted his approach. Carlos's education was expensive but effective. Experiential learning beats theoretical knowledge in investing. Small losses teach lessons that no textbook can provide. Trial and error creates intuition that analysis cannot replicate. Gut decisions versus data-driven. Smart investors make data-driven decisions. Every choice is backed by spreadsheets, ratios, metrics, and quantitative analysis. They have mathematical justification for every investment. Meet Lisa. Lisa buys Disney stock because she loves Disney movies and theme parks. Lisa's analysis. Disney makes people happy. Happy people spend money. Lisa's gut tells her Disney will do well. Lisa's emotional connection to Disney helped her hold through volatility. When Disney dropped 40%, data-driven investors panic sold. Lisa held because she believed in Disney's magic, not their metrics. Lisa's gut decision outperformed sophisticated quantitative models. Lisa's emotional attachment created conviction that data couldn't provide. Lisa held winners longer and sold losers faster because she trusted her instincts. Gut decisions create emotional conviction that data-driven decisions lack. When you believe in something emotionally, you hold through volatility. When you only believe in numbers, you sell when numbers change. Bootstrapping versus sophisticated funding. Smart investors use sophisticated funding strategies, margin accounts, options strategies, complex derivatives, and leveraged ETFs. They optimize their capital structure like a hedge fund. Meet Robert. Robert only invests money from his paycheck. No margin, no leverage, no complex strategies. Robert buys stocks with cash and waits. Robert's approach is embarrassingly simple. During market volatility, Robert's simple approach outperformed leveraged strategies. While smart investors got margin calls and forced selling, Robert just held his positions. Robert's simplicity became his strength. Sophisticated investors got wiped out by leverage during crashes. Robert's cash positions survived every downturn because Robert couldn't get margin called. Robert's dumb approach was actually risk management. Leverage amplifies both gains and losses. Sophisticated funding strategies work until they don't. Simple cash investing provides stability that complex strategies cannot match. Clear vision versus overthinking. Smart investors consider every variable: economic cycles, interest rates, geopolitical risks, sector rotations, currency fluctuations. They build decision trees for every scenario. Meet Patricia. Patricia has a simple vision. Technology will keep growing, so I'll buy tech stocks. Patricia doesn't worry about economic cycles or interest rates. Patricia just believes technology improves life. Patricia's clear vision helped her stay focused while smart investors got distracted by market noise. Patricia held tech stocks through every correction because her vision never changed. Simple vision creates consistent strategy. Overthinking leads to constant strategy changes. Patricia's dumb approach generated better returns because Patricia never second-guessed her basic thesis. Overthinking creates decision fatigue. Too many considerations lead to poor choices. Clear, simple vision provides consistent direction that complex analysis cannot match. Here's why dumb investors win. They act fast, think simple, trust their gut, and stick to their plan. They don't get paralyzed by analysis or distracted by complexity. Smart investors get trapped in analysis loops. Dumb investors build wealth through action. The market rewards participation more than perfection. This creates a paradox. Trying to be smart with investments often makes you dumb. Being dumb with investments often makes you smart. The market punishes overthinking and rewards simplicity. The dumbest investors win because they do what smart investors can't. They act without perfect information, hold without constant analysis, and trust without mathematical proof. Sometimes the smartest thing you can do with your investments is be dumb. Buy what you understand, hold what you believe in, and ignore what you can't control. Because in investing, being smart enough to be dumb might be the smartest strategy of all. If this video helped you see money differently, hit subscribe. New videos every week.